Time now for the word on Wall Street. Top investors watching your money. Joining me now is CIT Investment Associate Senior Vice President and Senior Portfolio Manager Bryce Doty. Also with me is Mike Lee. Mike, I want to start with you on tech because big second quarter earnings from that sector are coming out as far as these names. Microsoft after the bell today. You've got Meta tomorrow. Amazon, Apple is Thursday. The Wall Street Journal writes it's a cruel summer for tech stocks as the Magnificent Seven has shed $1.52 trillion in market value in the past 3 weeks. Biggest drop on record. But you've also got Chinese discount shopping apps, Temu, Shein, and TikTok shops. Rising popularity could influence U.S. tech and e-commerce earnings. So break that down for me, that last portion.
Yes, so what I think matters most for Microsoft today is going to be their cloud growth. I think it's going to be spectacular based on what we saw from Amazon. But the market has taken a very close look at how much these companies are investing in artificial intelligence. So Google, for the past 2 quarters, has sold off after earnings because the market is not impressed with the capital expenditures and the investments Google is making inside of AI. So Microsoft, it'll be interesting to see how much they disseminate, how much money they're making from their Copilot program and how much they expect actual AI to contribute to their earnings, whereas I expect the cloud business to just continue to boom. And tomorrow, Meta, the stock still has not recovered from earnings last quarter, even though they showed 20% revenue growth, 60% earnings growth. I expect to see massive numbers from them from both an earnings and revenue standpoint tomorrow. But it's going to be how much does the market, what is the market's interpretation about their investments in artificial intelligence? And then Apple on Thursday, are we starting to see this device upgrade cycle that has been promised that led to the stock really taking off because of AI coming to the iPhone? So the commentary around AI, and I'd say the commentary and the calls on forward guidance for all these companies is going to matter much more than the actual numbers and how the market appreciates a lot of this. And a lot of the investors behind these stocks are momentum computer-driven algorithms. So as the stocks trade higher, they're just going to get pushed. As the stocks sell off, they're going to get pushed the other way.
All right, Bryce, let's move on to the 10-year Treasury yield this morning, taking a look at that because we are kicking off the Fed meeting. Today is day 1 of 2. The Fed widely expected to hold interest rates steady tomorrow, but the futures market is fully pricing in a rate cut for September. You say the Trump trade means there is less of a chance for a recession. What does that mean?
Right. The Fed, you're right. The Fed is probably not going to do anything tomorrow. And it will be a little awkward when they try to telegraph that they'll cut soon, but why they're, try to explain why they're not doing it now. What may be having a bigger impact on the curve is the Trump trade. What the Trump trade to me is that there's simply less of a chance of a recession if Trump is elected. The current policies, the curve is inverted right now because people expect a recession. You have households and individuals being able to afford less and less, and that ultimately leads to a recession. We saw under Trump that the economy did well. That's his forte. Inflation was low, wages were going up, people were able to afford more and more. So if Trump was elected, then the odds of a recession virtually go to zero, and there's no need for the yield curve to be inverted. So the yield curve will steadily steepen the better he does. So that's going to be a big influencer. So the 10-year yield is right in the middle of where this curve is positioned, and it may not change a lot. The short end will go down, the long end will go up. We're repositioning our clients' bond portfolios into that 3 to 6 year part of the curve, which should perform the best.
Oh, interesting that you're making that move now. Mike, I want to talk about another sector that we haven't really gotten to yet. New data finds portfolios of foreclosed or seized commercial property reaching a $20.5 billion mark in Q2. That's a 13% increase from the first quarter, highest we've seen since 2015. Should we be worried about this right now?
Yes. So, look, I do not think this is going to stop or slow down as the Wall Street Journal suggests that there's some sort of bottom. I think this is going to be a long, slow bleed. If for some reason this were to accelerate, it could turn into a banking contagion. But with commercial lending, it is a very profitable practice for banks. And as a result, if these defaults and foreclosures are spread spread out over time, they can easily absorb these losses. If it happens in quick succession, then it turns into a banking contagion and things can get very ugly. I do not see that happening. And the best way a lot of this office building in commercial real estate has been described to me is like pyramids, right? And so they're these beautiful things to look at, and they're there, but after a while you realize it's a pyramid, and there's, it has no use other than being looked at. And so that's a lot of commercial buildings out there with the way that working has changed. So, I mean, I can't imagine we are near the bottom. I think that's a long way from here.
Yeah, that's a very good point about being a slow slog to the bottom. Thank you, Bryce Doty. Appreciate it. Good to see you, sir, this morning. Mike, you're going to stay with us all morning long.